The world's largest shadow bank. That's what experts call BlackRock. But unlike the banks you're familiar with, this financial titan operates largely outside traditional banking regulations. In the next 15 minutes, we'll examine how BlackRock's unique position allows it to shape monetary policy, influence governments, and potentially manipulate markets, all while avoiding the scrutiny faced by traditional banks. BlackRock, a financial giant overseeing assets worth over $10 trillion, manages more money than the entire economic output of Japan. If BlackRock were a country, its assets under management would make it the third largest economy globally, surpassed only by the United States and China. Despite its enormous influence, BlackRock remains relatively unknown to the average person, strategically positioning itself as a shadow bank operating in the background of the financial world. Founded in 1988, BlackRock initially focused on fixed income investments and risk management. It expanded its offerings over time with a significant acquisition in 2009 that propelled it to become the world's largest asset manager. BlackRock's business model differs from traditional banks, generating revenue by managing other people's money through a wide range of investment products, catering to both individual investors and large institutions. BlackRock's growth has outpaced traditional banks, especially after the 2008 financial crisis. It became a trusted advisor to governments and central banks, offering expertise in managing complex financial situations. This positioning allowed BlackRock to expand its assets under management significantly. The implications of BlackRock's influence are far-reaching. Its vast holdings across various industries allow it to shape corporate behavior and market trends. Investment decisions by BlackRock can impact stock prices and entire sectors of the economy. The company's role as an advisor to governments and central banks raises questions about potential conflicts of interest and the blurring of lines between private financial interests and public policy. BlackRock's scale and position enable it to influence monetary policy in ways traditional banks cannot. By advising central banks and managing government bond purchases, BlackRock has direct access to global financial decision-making. This level of influence raises important questions about accountability and the concentration of financial power. To understand how BlackRock maintains its edge, we need to examine the technological advantage that sets it apart from competitors. This brings us to Aladdin, BlackRock's key tool in the world of finance.
There's something called Aladdin that BlackRock owns that works more or less exactly like ChatGPT, except it was built originally over a decade ago.
In the heart of BlackRock's operations lies a technological marvel called Aladdin. This asset, liability, debt, and derivative investment network is BlackRock's proprietary risk evaluation and risk management system, powered by 5,000 computers that analyze millions of daily financial moves across global markets. Aladdin oversees $21 trillion in assets, more than the annual economic output of the United States. What sets Aladdin apart is its ability to examine each asset in clients' stock holdings, understanding how they might be affected by even the slightest economic shifts. This granular analysis allows BlackRock to anticipate market trends and potential risks with high accuracy. During the 2008 financial crisis, the Federal Reserve turned to Aladdin for help in managing and analyzing portfolios, showcasing its analytical power and influence on major financial decisions during critical times. Aladdin's reach extends beyond crisis management. From 2014 to 2015, BlackRock used it in over 1,500 private engagements with companies in its portfolio, shaping corporate governance and investment strategies across various industries. However, the concentration of such vast market insight in one system has raised concerns among experts. Some worry it could lead to a shareholder oligarchy, where a small group of large asset managers, including BlackRock, wield disproportionate control over corporate decisions and market dynamics. The continuous market scanning performed by Aladdin gives BlackRock an unparalleled ability to spot trends and potential risks, further cementing its influence over market movements. Perhaps most concerning is the lack of regulatory oversight. BlackRock self-certifies its compliance with passive investment terms, potentially allowing unchecked power in the financial sector. As Aladdin continues to grow in scope and influence, Questions about transparency and accountability become increasingly pressing. To fully understand how BlackRock leverages this technological advantage, we need to examine its deep connections within the halls of government and explore the revolving door between BlackRock and the world of politics. While Aladdin crunches numbers, another system operates behind the scenes, one that trades in influence rather than assets. The line between regulator and regulated has become increasingly blurred, creating a complex web of connections between BlackRock and government agencies. Since 2004, BlackRock has strategically hired numerous former government officials, regulators, and central bankers worldwide. This practice gives the firm unprecedented access to the corridors of power and raises serious concerns about potential conflicts of interest. When former BlackRock employees take up government positions, they bring intimate knowledge of the firm's operations. Conversely, when government officials join BlackRock, they carry valuable insights into regulatory processes and policy making. A prime example of this phenomenon involves Larry Fink, BlackRock's CEO. In 2016, Fink was involved in high-level discussions about potentially becoming Hillary Clinton's Treasury Secretary. While this didn't materialize, it illustrates the close ties between BlackRock's leadership and top government positions. BlackRock's influence extends beyond personnel exchanges. The firm has significantly increased its lobbying efforts, particularly during attempts by the Financial Stability Oversight Council, FSOC, to impose additional oversight. By leveraging its connections and financial resources, BlackRock has maintained a unique position in the financial world, wielding enormous influence while avoiding the scrutiny faced by traditional banks. The firm's reach isn't limited to domestic politics. BlackRock has cultivated relationships with international bodies that shape global monetary policy, such as the International Monetary Fund and the World Economic Forum. This global network further complicates the relationship between corporate interests and public governance, raising questions about whose interests are truly being served in international financial decisions. As we consider the implications of this intricate web of connections, it's clear that BlackRock's influence extends far beyond asset management. The firm has positioned itself at the intersection of finance and policy, with the potential to shape regulations and economic decisions that affect millions of people worldwide. To understand how this concentration of power and influence impacts the average person, we need to examine BlackRock's role in shaping market dynamics and its effect on everyday consumer prices. Let's explore how the decisions made in boardrooms and government offices ultimately reach into your wallet. BlackRock's ownership stakes in competing brands across various industries raise questions about market competition and consumer impact. The firm holds significant positions in major athletic brands like Nike and Adidas, creating a scenario where it benefits regardless of which company performs better. This ownership model, known as common ownership, has implications beyond simple diversification. Studies have linked it to reduced market competition and higher consumer prices. When companies under common ownership don't compete aggressively, they have less incentive to lower prices to attract customers. Instead, they can maintain higher prices, knowing that the major shareholder benefits regardless of consumer choice. This dynamic creates a form of neo-monopoly where companies don't need to merge to reduce competition. They can all profit from the same large shareholders, leading to a lack of competitive pricing and innovation. As a result, consumers pay more for products across various industries. BlackRock's influence extends to employee compensation as well. The firm's focus on short-term returns for shareholders often comes at the expense of worker wages. This prioritization can lead corporations to increase profits by limiting wage growth rather than investing in their workforce. The effects of wage stagnation ripple through the economy. As workers struggle with stagnant salaries, their purchasing power diminishes, impacting consumer spending and economic growth. This dynamic contributes to the widening wealth gap and economic inequality in many countries. BlackRock's ownership structure and investment strategies have tangible effects on our daily lives, from product prices to wages earned. This concentration of economic power raises crucial questions about market dynamics and regulatory oversight. As we consider these far-reaching implications, it's important to explore potential solutions and the role of regulatory action in ensuring a more balanced and competitive economic landscape. Addressing these issues could help create a more equitable economic system that benefits a broader range of stakeholders. The concentration of power among a few large asset managers like BlackRock raises important questions about economic fairness and market competition. While increased regulatory oversight is being considered, addressing these concerns requires public awareness and engagement. We must critically examine the role of these financial institutions in our economy and political system. Moving forward, it's essential to consider how we can create a financial system that balances growth and innovation with fairness and accountability. This is not just an academic exercise, but a practical necessity that will shape our economic future. By staying informed and actively participating in discussions about financial regulation and policy, we can all play a role in shaping a more equitable and transparent financial landscape.